Small initial deposit trading. It's well known that 95% of novice traders lose their money within 1 year. But is this actually true? And if it is, why is this happening? I believe it is true, and here's why. More than 95% of novice traders with small initial deposits lose their money. Note that I'm making reference to small initial deposits. The greater size of the initial capital, the less likely you are to lose money and vice versa. So, if you have an account of less than $1,000, it's very likely you will lose this money. In fact, there's a 97% chance it will all be gone within the first 3 months. But if your account is $50,000 or more, then you're more likely to make money trading on the Forex market. This presentation isn't saying that you should open an account with a large sum of money, but it will show you how you can make money on the Forex market starting with a small initial deposit. Before we can do that, we need to understand why traders with large accounts are more likely to earn in the Forex market. The 3 most important reasons are: 1. Brokers provide better conditions, spread, execution time, no dealing desk. 2. Traders with larger accounts will usually deal in lots that make up a smaller percentage of their overall deposit, about 1 to 2%. Whereas traders with smaller accounts trade with lot sizes that account for about 10 to 20% of their deposit. 3. Traders have access to more information, Forex analytics, etc. Okay, so how can you start trading and be successful with a deposit of $5,000 or more? First of all, you should set up with a real ECM brokerage company. Don't expect that the broker will bring your orders to the interbank, because banks and institutional brokers have a lot minimum of 1. But a lot of brokers have their own price aggregators, and they will allow you to trade with a lot of 0.1 without manual intervention. But don't just choose any broker, and be wary of online reviews, as they're usually created to advertise a particular brokerage company that may not be the most reliable. Second, money management. You shouldn't risk more than 5%. Actually, I would recommend 1 to 2%. For example, if you have a current account balance of $10,000 and the expert advisor can open 3 orders simultaneously, your order size should be 10,000 times 5% divided by 3 orders equals 166 equals 0.17 of a lot. I'd also recommend not using any martingale strategies or trading without stop loss. Third, information and knowledge. There is a saying that if you've never worked the lathe and you try to carve detail, you're very likely, about 97% likely, to damage your fingers. Similarly, the Forex market punishes inexperienced traders. It usually takes about 3 to 5 years to develop your own profitable strategies and become successful in the Forex market. You can lose a lot in this time, including your enthusiasm for trading and thousands of dollars. So this is why I would recommend that you find and buy a good, stable Forex robot and start earning money within a couple of hours. This does not prevent you from simultaneously developing your own method of Forex trading. As a guide, the Forex robot should be tested on real accounts for at least 1 year. You should also check how the robot trades in both flat and trend market conditions. As with broker reviews, don't always trust the online Forex robot reviews or ratings, as they are also usually only advertising a specific Forex robot, which won't always be the most reliable. What you should trust are time-tested Forex strategies, developers, and real account proofs. So, with this in mind, I would recommend the Expert Advisor TFOT. You can find more information about this robot here, http://iticsoftware.com/FXRobot-TFOT.